So inclusive investing, we're increasing the pie. And through that process, there will be disproportionate outsized returns because all we're doing is pushing two normally distributed curves together, and we'll be able to take the bulk of that. Once that starts to happen, the money will flow into these demographics, and these founders will no longer be relatively overlooked. But that's where we're going. And so those are the statistics that we're trying to provide some solution for, and we are trying to help, close that gap.
Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and today we're with Alice Vilma, who's a managing director and co-head of the Next Level Fund at Morgan Stanley Investment Management. So that's right, the investment bank Morgan Stanley is set up now with a Next Level Fund, and their mission is funding diverse founders from African American, Latino, and I believe women-led companies as well, but Alice will fill us in. Alice also founded the firm's Morgan's Multicultural Innovation Lab, which is now the Morgan Stanley Inclusive Ventures Lab in 2017. And so basically what we've got here is we've got the Next Level Fund, which is, I believe, a VC fund focused on Series A and beyond. And then you've got an accelerator, which is like a YC Techstars thing, but focused on a underserved demographic. So Alice, I want to first dive into kind of the why and the what is the problem here. I mean, social injustice, everybody knows, even if you're not in the industry, you know that the percentage of African-American women founders to get funded to Series A is like appalling. And I'd like to get maybe a stat or two statistics. I mean, you would know this, maybe benchmark us to compared to some other countries. And where I really want to dive into, which is less obvious to everyone, is the business case. So maybe focus a bit on there's an opportunity to make money. I think Morgan Stanley has a reputation for not losing money, and they know how to make money. So maybe what is the business case here? And then I want to focus on what Morgan Stanley's specific approach is. You're the co-head of this program. You started the accelerator. And so how are you guys doing? What are the specifics on how you're going to win at this and make some change, and maybe even launch a broader ecosystem around you guys? And then, of course, I want to talk about you. So maybe why don't we start with the what and the why? What is the problem? What is the problem, and where are we?
No problem, Andrew. It's great to be here. Thanks for having me to begin with. And I think the problem, which is, I guess, the world's best unkept secret, right, is the cash and the funding and the access to capital, as well as networks, but really capital that's available for generally founders of color and women. When we think about the data, and the data is, surprising, but it's not super, it's not a super surprise to people who have been in this space, is that for every dollar that's invested into a company with generally white male founders, you have less than 25 cents total going to Asian, Black, Hispanic, and women founders. So
and how does that compare to the demographic of our fine country's population?
Well, again, if you think about the population of the United States, you have about 13% Black population. The Hispanic population is growing, so you're looking at 30–40%. And at some point, the Hispanic population will have the plurality of the United States, and women clearly about half the population. And so if you're just looking at things, and this is how we started the journey with respect to inclusive investing and the Next Level Fund and the Inclusive Ventures Lab, around why is the parity so different when companies get large. And so as we started to peel the needle back and back, look at pipelines, look at what was feeding the private equity channels, the middle market private equity channels, the small cap private equity channels, growth VC, regular stage VC, early stage VC, you keep going back and back. And then you notice that this parity, i.e., the amount of founders that are representative of what we would generally see in the country, happens at the earliest stages, like when you go to charter a company. And so then we go back.
But Alice, I don't think I've missed a YC demo day when they did them in person, and I've just been nothing but this industry as a founder my whole life. And then, so I noticed that all the founders were guys. And it was, it's not all white men, but it's a lot. What I'm observing now, and maybe we're jumping into this too fast, is that you've got guys like Dave McClure who saw the business opportunity that we haven't got into yet. And Dave was like, you know what? If nobody else is going to fund a woman or an African American, guess who's going to? Me. And I'm going to make money and tap into this untapped thing. And then there's been a lot of movement. New York City, I would say, even more than Silicon Valley, covered with accomplished women that are saying, what the hell? I'm going to start a VC fund. And I know some people that'll back me. But it's mostly at the seed stage. What I don't see is, some people listening to this would be like, oh, the next level fund is only going to fund me when I get past the impossible hurdles. There's actually a lot of infrastructure that's been deployed in recent years for that early stage stuff, but not a ton actually on a Series A crunch level, or B or growth, and the networks are lacking and stuff like that too. But okay, so we talked a little bit about demographics. Do you want to hit us with any kind of scary statistic of how we're doing compared to other countries, or to kind of amplify the what and the why and the problem?
So I would say that in terms of other countries, quite frankly, are a bit homogeneous. So, but when you think about the funding that goes to women, particularly in kind of culturally homogeneous countries, it still is very lacking. So you have other areas, the Middle East in particular, because we get some information from our lab about those companies. They're looking to fund more women. In Europe, it's actually very, very stark as well, particularly from the women demographic and the gender demographic. And it looks, quite frankly, a lot like the United States. Canada is exactly the same because that's where we're also investing. And so when you think about this, the issue that we see, and go into the business case a little bit, I know it's a little bit early for that, but it's saying, what we're saying is we're bringing more people in to this population. So inclusive investing, we're increasing the pie. And through that process, there will be disproportionate outsized returns because all we're doing is pushing two normally distributed curves together, and we'll be able to take the bulk of that. Once that starts to happen, the money will flow into these demographics and these founders will no longer be relatively overlooked. But that's where we're going. And so those are the statistics that we're trying to provide some solution for, and we are trying to help, close that gap.
And Morgan Stanley has the resources to have an analyst or two that stays in the office till 2 in the morning, I would imagine, having grown up around some of that. Is there some clear kind of business case stats that say if someone else is not going to fund this demographic, we're going to, and we're going to find some diamonds in there. And if we can, be the Sequoia Kleiner that everybody parts the season goes to, Morgan Stanley sounds good, might be a good partner to build your business. What's the business case there?
So that exactly is the business case, Andrew. You pretty much are reading my mind, quite frankly, but the idea is exactly that. There's an ecosystem already at the very early stage. Friends and family, there are accelerators who started to replace some of that. Some of friends and family can be helpful. And I think from an angel perspective, angel groups and networks, as long as these founders can find those networks, they're here. There are affinity groups for that, et cetera. So that part of the segment is done. It's at the institutional level that, as you mentioned before, where we see the opportunity, Series A, B, because that's where the demand is. And then hopefully as we continue to grow, we push companies through to the growth stages and private equity, et cetera. We can do that in a couple of ways. We can create larger funds to do that, or we can hand them right off. Because I think that a lot of later stage investors are also looking for ways to diversify their portfolios. It's conversations that we've had. They just haven't been able to, quote unquote, find. And it's not necessarily an easy excuse. It really isn't. There's something systematically that we're looking to change here. And I think we're being a little bit helpful in that. And we're starting to see some of the green shoots around it. But that's exactly where we're going. Institutionally, begin to find these founders, and really begin to invest in those ideas that just are relatively overlooked, or maybe there's some pattern matching. We believe that, me particularly, I know something about these founders that others don't. And so while we are beginning to cut the brush, if you will, and begin to pave the way, as we start to see results and as we start to see returns, then we believe more money will flow into the space. But we've taken the lead, so we'll be able to become a leader in the space.
This was not obvious to me until I was speaking to a fellow VC that's a woman in Silicon Valley that talked about the issue of networks. And so maybe you could talk a little bit about that. I mean, she gave an anecdote of when she got her MBA, a bunch of the men would go off and play basketball and then go out for, a beer or a cocktail afterwards. And she just wasn't invited to that. She wasn't playing hoops. She wasn't in the room where they were having their drinks. And when she goes to raise money for her fund, these guys are worthless. And all the women that were in the MBA program are married off. It's like, and she's the only real, worker there. Maybe talk a little bit about what you've come to understand with the networks and maybe how you guys are going to address and attack that.
So this is the part. So you've got the access to the capital, then you've got the networks, and this is the part where folks say, oh, it's not fair, it looks a certain way. And at the end of the day, it's all about, and I understand when you think about this systematically, networks are generally closed. And the reason for that, or what I would hypothesize is some of the reason for that, is anything that is unknown bears risk. And so when you think about that as you're putting money to work, it bears risk. I may lose money to anything that's unknown or things that are unknown that I should have known. And so when you're looking in certain spaces, the VC sector as one of them, I liken it to the film and entertainment space. Why do you see so many sequels in movies? Well, because you already get the people in the seats. And that's why
it's Black-Scholes price option theory. You can get it down to the number of how much am I overpaying or underpaying to fund the sequel. If it made this much, it's going to make at least this much. I'm willing to live with a 3x return. It's like that.
That's exactly right.
By the way, that's another big issue is that if the African American, Latino, people of color, women were underfunded to begin with, we might have to explain what non-participating liquidation preferences mean to that person.
100%.
Whereas to the guy who is on his fifth startup, he's telling us how he wants to do the pref.
100%. And so that bears some risk. Now, look, the first-time founder base goes across demographics. There are books that have been written on this. So Brad Feld, Venture Deals, he explains how this works. But again, someone who's gone through this motion a few times, number one, has his own networks. Number two, those networks stay closed because they want to keep funding this person because they're a proven entity. And that's what we have to develop with other demographics and founders who don't necessarily have the same networks. And so it is in those networks where there's a little bit more familiarity, particularly with respect to our fund and the partners in our fund. It is a reason why some of the themes have been talked about in other funds to diversify their investors, because then you get to really be able to open up the lens and pick from 100% of the opportunities instead of 50% of the opportunities. So all we're saying is we're looking at the best of the other 50%. That'll produce outsized disproportionate returns because that 50% has relatively been overlooked. And that should start to move the needle, particularly on a platform like Morgan Stanley's, where we have the best ability to have the right distribution of capital. We get a very, very high profile, and there's credibility with respect to the founders we're looking at.
Right. So I think that's clearly part of what's happening here is that if I went to school, even high school, with somebody that knows the founder, I should be able to pretty quickly do off-sheet reference check.
That's
so
right.
Don't give me a sheet of names. I'll go off-sheet and find out if you're good or bad, sort of, or what you are. So I can check up on people. When you come to somebody that grew up in a completely different environment from the 5 white men from Boston who pretend to be from Palo Alto situation, that they don't even know who to call. Now, if we see that they got the credibility because they got through your venture lab at Morgan,
That's
you
right.
can assume that there was some sort of vetting on those entrepreneurs.
That's right.
So I kind of think that could be part of it. If you get every other bank to competitively copy what you're doing, how wonderful.
Right. And let's talk about that. So we'll go back to the lab a little bit. When we started in 2017, we had 5 companies. And the whole idea was, wow, to investors that we spoke to in the space, wow, let's look at all of these founders because we are interested in diversifying our portfolios. That's how we're going to get to the right construction and return. How do we help these founders, and these founders got funding. The lab has provided funding, I believe, of over $150 million to the companies that have come through, which is amazing. They've had about 100 companies, and they still continue to perform. They've even expanded, as I mentioned before, into the EMEA region. And so the fund was born out of the premise of the lab. And where we think we have differentiation, particularly, is in our LP base. Not only are we bringing the auspices of Morgan Stanley as a franchise to this group of founders in our portfolio, but also the likes of Walmart, Hearst, right, Microsoft, Altria, a healthcare family office, where they say, okay, we want to also be involved. And how do we think about the commercial opportunity and engagement levels with the companies in our portfolio, which speaks volumes, number one, to the ability to accelerate the business, but number two, there could be outsized exit potential, and we're already speaking to the folks that most VCs go to anyway with respect to how we think about exits. So this type of partnership, if you will, with LPs, as well as we grow the fund with others, but this is where we do see a real competitive advantage in the ability to bring differentiated value add to these companies and really begin to think about return.
So there's a CVC, corporate venture capital element to bringing on strategic LPs, to what you're doing. I wanted to get into the specifics of like how you're set up after we got the what, the why, and the opportunity, the business case. So let's come back to the CVC or strategic LP side. Tell us specifically, what are the specifics on the lab now? The cohort of 5 sounded highly concentrated for seed if you were trying to diversify risk at that early stage. But I like the idea of quality and, high touch attention to help. But where is it now? So maybe skip past the past. 2017 is a long time ago. How many cohorts a year? How many startups? What does the program do?
So the program acts much like a Techstars. It's a longer program, so I believe the program is about 5 months long, and there's one cohort a year, both in the US and in EMEA. And so it still is seed/Series A, and they are providing capital to these companies in the form
of— How much?
So there's $250,000. So relatively, good sized capital to the companies that are participating, and then a full curriculum. Back to your point about how do you think about participating preferreds, and how do you think about different types of securities, and how do investors and professional investors think about the space. They do friendlies with investors as well, so you can go pitch your company and get feedback and really begin to level up, if you will, just a foundational knowledge base of this group.
By the way, can I say that, we already kind of put a spotlight on the network issue and how real it is on a basketball game. And I wasn't there having those drinks and developing that relationship. That is what these relationships is what makes business. Morgan never stops talking about the relationships. I really think even if you're a white guy from Boston, the accelerator, any good accelerator, has you meeting all these mentors, almost predators hoping to get in before the demo day kind of stuff. That meeting all those people, you just leap out of the island of I ain't got no network to meet all these people. So right. I think that's a huge thing. Going to any accelerator for an under networked person or first time entrepreneur. So that's a key. You're solving a problem there.
That's exactly right, because you start to then begin to expand that network once you introduce to someone who, even if they're not able to invest today, wants to be helpful and put you in touch with others. Not only do you do that, but then you get the cadence of what investors are looking for. And so that's where these founders, their learning is actually quite exponential. And for the ones who have great opportunities and who are seeing great traction and moving very quickly, they move light years ahead, because they just pick up the little bit of information they didn't have, complement to what they're doing, and they just keep right on going. And the fund looks at those companies too.
And is this a return to office or is this virtual? I mean, we'll get to EMEA, but in the US, everybody comes to New York, or where does this happen?
So it's hybrid. And so the lab right now brings people into the office generally a couple of weeks over the program, and then most of it is virtual. Same thing for EMEA. As you can expect in that region, it can be quite difficult to bring people from different countries and areas into London full time. And so they do the same concept.
When did you launch the lab or accelerator in London?
The lab in London was launched in 2022, the first cohort, and again, 5 companies, and now they've grown to 10. The lab here does up to 20 companies on a yearly basis.
So is that 2 cohorts of 10?
One cohort of 10 to 20 companies.
One cohort of 10 to 20, and it goes for 6 months.
Yes.
Okay. Okay. You get the summer off, sounds like.
It actually, so it's funny, it starts effectively, you're absolutely right, effectively in September-ish and then goes to the end of the year.
Okay.
Yeah.
Okay. Yeah. I think funding, I always think of fund. There's two like killing seasons of raising money. There's let's start in like January 3rd, and we've basically got till the end of June, especially if you're in Europe where they really go off on their boats. And then the second killing season is let's get our stuff together in, mid to late August, as soon as kids are back in school, wherever that is. Let's crush until Thanksgiving, and then people only focus on what they already started, before the end of the year. So these are kind of your 2 fundraising seasons. So I think that's a good going from September straight through to, end of June is not bad. Okay. And so internationally, what's the roadmap plan? You've already got a setup in London, but that covers all of EMEA?
It covers all of EMEA. And so the thought is, again, to the next level fund was born out of the Inclusive Ventures Lab. And then we would look to expand in the same way once we understand what's happening on the ground, particularly at the early stage. Obviously, valuations are a little bit different than in the United States. There may have been some convergence. We're also starting to see other funds from the US move into the particularly UK region, but tackling EMEA. And there is a lot of opportunity, again, around inclusive investing in the Middle East, but we just need to understand locally what is happening in these markets such that we can begin to take advantage and leverage that through a GPLP structure.
By the way, I've spent a fair amount of time in places like Saudi Arabia, UAE, Qatar, Bahrain, and even I judged a Startup Istanbul event where, like 2016, with everybody was across the entire Muslim world. So like Indonesia, Jakarta, startups, everything. And I was blown away to see these women with hijabs on. It was 50%. I swear to God, at the sea level, it was 50% women. And in Riyadh, it is 50% women. And it's just shocking. I mean, you just assume it's not going to be that. And we're the ones trying to catch up with that on the startup level. And there's actually a lot of reasons why, like, probably, why is it that so many Jewish people become great entrepreneurs? Because they were kind of like not allowed to do the other jobs. They didn't have a job in government. So they end up running the Medici Bank and banking the Pope, ironically. Whereas, if you're kind of like not allowed to work in the big government job that everybody want, or getting some contract to empty all the bins of all the airports and just crush money on that, maybe you're on the internet and there's a problem and you're solving that problem and you've got a little access to capital. So it doesn't shock me that women are kind of 50% of the game in places like Saudi and UAE. It's just not it's a little counterintuitive though.
And so that is, and it's interesting, when we started down this road of inclusive investing, period, there was the same thought. The same thought was like, the demand is not here, not really sure what this looks like. But as Frida Kapoor really says out of Kapoor Capital, ability is normally distributed. Access to be able to capitalize on those abilities and those opportunities is not. And so that really is all that we're doing. Back to your point, the demand is there. Our pipeline is robust.
Oh, yeah.
And so all it is finding the best of those investors. I mean, of those founders.
Yeah, I mean, it's been clear to me forever that the entrepreneurs are everywhere. Like,
Right.
if you look at like Israel did it, Paris did it. You got like BPI France, British Business Bank, EI, European Investment Fund. They once they say we're going to fund every VC in Paris, and the entrepreneurs were always there. There was just the lack of that. What is really it's very easy for Macron to say, all right, this we're turning $1 billion into 10 billion, or the BBB triples their budget with Brexit to put LP capital into funds. So you always had the entrepreneurs. Now the money's there. Boom. What's not so easy to replicate, and Morgan can play a good role in this, is the big balance sheet buyers. Where's the exit? Who's going to buy this company? How does the government get their money out? How do they matching LPs get their money out? And you've really only seen it in Silicon Valley, US, and China, if you ask me. If SAP bought your company, well done. They're not known for being generous. You'd be much better off selling to Oracle than them. So Morgan being able to play a role of the machine to create exit liquidity in some of these emerging ecosystems could be interesting, you know, not least of which if they're in the US where we have the natural buyers right here. You know, that's a role. Let's come back to that, but that's a good segue into CVC strategic. Yeah. So I didn't know you had all those other guys. I knew you had Walmart.
Mhm.
And you've been, when did Next Level Fund actually launch?
We launched in 2021. That was our first close. And so,
Okay.
yep.
And was Morgan Stanley Management the exclusive LP at the beginning or just the anchor, or can you talk about what that looked like?
Yeah, there were four at first close. There were four LPs: ourselves, Walmart, Microsoft, and Hearst. And
Wow.
that's where we started. And we started off with 35 million, and then we rounded out the rest of that 15. As we said, well, Altria and another healthcare, a family office in the healthcare space who was corporate, and that was the pilot, if you will, or the beginning of this journey with respect to the GPLP structure.
You know, Alice, my probably best network entry point into sourcing great African American founders was through an NFL and an NBA LP of mine.
Not
So,
surprised.
you know, like we met these guys, and you know, they're just magnets, whatever. Their entourages, literally, and so it was through them that they had invested in companies themselves
Yep.
that they brought up, and it's just been kind of fun and exciting, you know, journey, you know, for us. But that was really my personal entry point. So if I had Microsoft and Walmart and these other strategic LPs, are you able to figure out some infrastructure to create communication between the startups and the LPs to help them and you know distribution or partnerships and all that?
Yes, so that is the beauty of what we're doing. Most of our companies, we have representatives on our LP advisory committee from these corporates, and they effectively get walked through these organizations. So they are getting meetings that it would take years for them to try to get on their own. And that's the beauty of what we're doing. As we look at each of our investments, we say, okay, all right, Microsoft, this is where we think this could be interesting. These are the meetings we'd like to have. These are the areas that we think we could add value. Do you agree? Does this make sense? And we have those dialogues, and we have the same dialogues with each of our LPs to then understand how we're going to add that value. And so we begin on day one with the ability to make these introductions. And some of it's pilots because these companies are still relatively small. Or we're looking at Series A, we're looking at Series B. Yes, they have $1 million or a couple $1 million in revenue, but again, given the size of our LPs, they still are relatively small, but the idea is to grow them. And so what we see is sometimes they have they work with their diverse supplier bases and the diverse vendors to make sure they're getting the right POCs. But also, some of these companies that we're investing in are technologies that are interesting or playing in spaces where Microsoft, as an example, isn't. And so they want to understand more about it and they want to be able to be helpful. And so that's where they get involved as well. And so for each of our investments, there has to be some commercial overlap with at least one of our LPs. And then we begin that process of walking them through, having the right meetings, getting in front of the right decision makers to then be able to ascertain what's the commercial value here.
Okay, let's get into some specifics about what are the criteria, selection criteria, investment criteria. They're getting 250K to get into the lab, to the accelerator, you know, and I would think 5 months better than 3 months, if you ask me, you know, whatever that, you know, number was. And what is the criteria and stage at which you're investing, or even geography, you know, geography stage, investment themes and sector for the fund. So sector, stage, geography. Let's look at the next level fund maybe first, or whatever you want. Lab first probably chronologically comes first.
Okay, let's start with labs. So sector agnostic for the most part, they look at just about everything because they use the sector expertise of Morgan Stanley as a firm to get smart on these sectors. And so you're looking at seed Series A, you're looking at revenue. Generally speaking, companies that do well in the lab have a couple $100,000 in revenue to approaching $1 million in revenue. They're generally raised
Annual.
annual, yes.
So what's the lowest revenue level that an entrepreneur should expect to be saying, hey, they didn't say no to me because I was too early?
Yeah, I would say you're probably looking at least 250,000. That's probably the lowest level, $250,000 in revenue going to 300, and then that growth trajectory has to look pretty good. And that would probably be lowest amount.
Okay, and do you guys have like a set deal you try to impose on everybody? Because when companies have revenue and there's discrepancy like that, just taking the YC deal hurts. You want to negotiate. So 250K, do you negotiate the, you know, pre-money, post-money, safe cap, whatever on these things, or?
So generally speaking, the lab does not, and I think it would be very case by case as to how they think through negotiations. So it's not completely blanket, but there are a few, I think, deal breakers for the lab that they want to make sure they keep. So the equity percentage is something that they want to make sure that they keep. And the reason I'm purposely not saying how much in equity they take is because it does change. And so I want to just keep them honest and not necessarily box them in for anyone who's listening and said,
No,
ah.
listen, I ask all the rude questions. I know exactly which one's the rudest. It's okay. It's okay.
Exactly. And so then we just need, there's some transfer information that we need and board observer seat. And then that's pretty much it. And then everything else is pretty much up for negotiation with these companies for the lab. But it's the same deal. It's 250 for a certain amount of equity, and that's that. Um, and I think that the lab has done well with companies who have said, no, thanks, this is not really, interesting for me. And we say, okay, who's up next? And they're able to continue to provide great companies because they're not taking a lot of companies vis-a-vis the volume of applications that they actually receive. So it is, kind of is what it is. For the fund, we're looking at really Series A and beyond, Series A, B, and a little bit of C, but we
Can you
really
define that with MRR or ARR, monthly annual revenues?
define what we need from the labs.
Yeah, no, at the fund level. So the next
Yeah,
level fund. So now this is not accelerated. This is a VC fund.
that's right.
And you're not doing pre-seed.
That's
I
right.
mean, the lab's not really doing pre-seed. Um, what should AR? What's the band range of MRR or ARR, whatever you guys thinking?
We're generally looking at ARR of $1 million in the fund. And so that's where we're going.
That's
We've made
pretty early. That's earlier than A, really. I mean, definitely.
it.
That's what I think you're in late seed. You're late stage seed, which is, by the way, a fantastic entry point to be investing if you're trying to make a multiple and lower
By the way,
risk inflection point.
I don't disagree at all, particularly at the size of our fund, which is 50 million. This is where we play best, actually, to your point. But that's lowest. And so we're seeing companies with generally, 2 million, 3 million going into and then above. And then we're generally the first institution, or it's the first institutional raise for a lot of these companies. And so that's how we work. And then given our ability to add value, we take board seats and excuse me, let me just say that again. We take board observer seats for every investment we make, and then in certain cases, board seats for our companies. We can lead as well as co-invest in these transactions that come through. And so we're comfortable with both. And we also are relatively sector agnostic because our LP base is so large. We have the ability to not only have the sector expertise, but get it from all of our LPs. We probably don't play really in biotech as an example, and traditional real estate, but other than that, we're open for business. Generally tech and tech enabled. So that's really where we kind of draw the line.
Okay, cool. And you know this obviously better than almost anybody in the world, certainly me. Was my assessment off that there's been a lot of people, I mean, especially like post George Floyd, you had people just throwing money out of guilt or something, and it all goes to seed. And even if you look at how governments behave, like British Business Bank, BPI France, EIF, European Investment Fund, they're like, we want to create these startup jobs, but if you ask us for growth money, that's like Occupy Wall Street. You're taking the piss. I'm not going to give it to you. And I'm like, why do you think all your companies are going to get acquired by American buyers? Because you can't get anybody on the stock exchange. You give up because there's no growth money for your startups, Mr. Macron. What do you think about the lack of growth money that's focused and dedicated? And is that something that needs to be fixed or it doesn't? Maybe by the time you're that growth, it just don't matter. And like, show me your unit economics.
I would say it's mostly there. Once we see, and it's interesting, there are a few companies that we've paid attention to, Calendly being a great example of this. And once they hit kind of that unicorn status or they get that very large check, their ability to interact with growth investors is actually not a problem. And so once a company is going, they can keep going. And so I think that the exit is coming shortly. Now, that being said, yes, of course, there can be more growth capital that comes in. Those are areas that, as we think about the life cycle of what we're doing as a platform, that we want to be able to tap as well. But I think the majority and the bulk of the investment is at the earlier stages, given the discussion that we just had around the statistics and the numbers. Once we saturate there and continue to push a good pipeline of these companies into the growth spaces, then we think about what dedicated capital looks like. But I will say we don't have problems sending companies into growth investors for
Yeah.
meaningful conversation investment.
Yeah, I don't think a dedicated growth fund beyond like B is really necessary. I think that the
Right.
growth guys are just like Japanese who know how to use Excel and don't know how to figure out the voodoo of plugging a hole in a tech roadmap. But
And to be fair, at the growth, we do have a hypothesis here that these founders, because the access to capital has been so scarce, they have actually mitigated risk in a way that makes them more mature. So when they're ready to scale, they really do take off. And so they're actually a dream, back to your point, to the growth investor who doesn't have to do much in terms of rolling up their sleeves to help these companies.
I mean, it's Darwinian, and if somebody got into the IIT in India with more applicants than Harvard ever had, there's something that the guy did well on the test or she did well on the test. I mean, so if you're in the like whatever Bernie Sanders half of 1% that made it, maybe this is like a serious athlete to back
Sure.
all the way, right? And those guys only look at numbers. So tell us about you. I know you got your MBA at Harvard. When
Yep.
did you join Morgan Stanley? Not to age you in any way.
So it's okay because it's all about how I look, not my age actually. No, so just kidding. So
Zoom is taking years off of you and adding it to me. I don't know what's going
and
on
the
here.
natural light, that's the key here, Andrew. It's the natural light. So I started at Morgan Stanley twice. So I started my career in '99 after a
Wow,
successful.
that's a fun time. That was a fun time.
It was a really fun time, and really before the first hiccup, obviously before the big hiccup in 2007. But it was great because we were doing structuring, I was doing banking, I was doing capital markets, learning a significant amount. And then I took that into a corp dev job right after my 3 years as an analyst at Morgan Stanley. And then I went to HBS. So when I came out of school,
Ah,
yep.
very
So
good.
when I came out of school, I went into a merchant banking platform that was investing in entertainment. So that's how I know a lot about the movie industry, and had an opportunity to come back to the firm in 2009 because of the crisis. So where I was, they were not doing well and had to focus on their core business, which was not merchant banking in the entertainment space. It was more kind of lending and gone to a bank. And so I came back to the firm, Morgan Stanley, in 2009, where I was doing capital markets on the structured finance side as well as equity, and then had an opportunity to start what is now the Inclusive Ventures Lab. And so that was through a kind of corporate strategy role that I had taken in 2015 with Carla Harris, who is my co-founder on the fund and the lab, quite frankly, and that had started with her. And as we were looking at how we could do more business with the multicultural business segment writ large, we started to understand where the most impact could be had with respect to creating those relationships. And it really was in the pipelining. Our bankers know who's running these companies. Our traders know who has these hedge funds that we need. Our capital introductions, they know those folks. So it wasn't a question of whether or not we knew who they were. The question was, how do we systematically begin to increase the pie? And that's how we started the thesis with respect to the lab and obviously with the fund. And here we are.
Yeah. Well, I mean, it's nice to see you guys taking your own medicine. I mean, they didn't put, three white guys from Deerfield Academy in charge of this endeavor.
Because it won't work. It won't work, Andrew. We see it, right? It's like you have to put folks who understand this space. I told you, we know people, we know more about this in this founder group than others. And we're just
Right.
taking that knowledge and capitalizing on it.
All right. And Alice, before we end, what's your advice to the next African American woman or Hispanic woman that wants to, start a multicultural lab at Morgan Stanley? I mean, this all sounds very Iron Man-esque. You get a cape on and this just happens. Not so easy. What's your advice? What's your advice here to people out there that might be inspired by you to get a job?
So, well, you can always come and see me, and as we grow, I'm happy to talk to folks. But if folks want to start something like this in their own organizations, I think the idea is speaking the language of business. That's the biggest thing, particularly in this era, which is a little bit sensitive around some of these greater topics around inclusion, inclusive investing, and just inclusion in general. And so you keep this to the business opportunity. We've talked about it this entire podcast, and there's an opportunity here and how to tackle that. And anyone at any large company is looking at how to continue to make money. And so once you're able to identify that, I think the discussions become a lot easier.
Okay. And Alice, I'm going to insist that you take a call with Hampton Ruiz and Jarvis Green. These are the guys from Chef to You,
You're
which
done.
is like you have like Uber Eats, DoorDash, Grubhub. They
Okay.
don't care about food trucks. They don't care about home kitchens, and they don't care about caterers. Hampton grew up in the projects outside of Houston, where apparently people would buy plates of gumbo, but it wasn't even safe to get into that building and that part of the place.
Right.
So there was some girl that was safe to walk through and deliver those plates of gumbo. And so it's basically Uber Eats has been going on with the second economy for ages outside of Houston. And so he's focused on food trucks and all that, which is Uber Eats is like pay me $3,000 a month to show up in the first 10 pages. So all you see is McDonald's and Olive Garden, So I'm going to force you to take a call with him if you don't mind.
I'm happy to do it.
And hope it leads to anywhere there. Anything else you want to tell us about yourself or about what you're up to, or a call to action out of anybody that might be listening to this?
Yeah, no, I think again, I'm first of all, thank you for giving the time to even talking about this entire sector. I think the conversation is so interesting for those who are interested in having it. And I'm also open for business for any great founders. And so I'm happy to take your meeting. Any other meetings you want me to take, I'm happy to take those as well, because we want to, again, really be part of the solution in bringing more money to the space and opening up this pie so that we stop pattern matching and we just start picking the best investors, the literal best investors of the 100% of the universe.
Yeah, I would say if any regulator is listening, we're not soliciting for securities in any way, but we are looking for countries, cities, municipalities, people, high net worths that are in corporations that are interested in making a strategic difference while making some mad money. So there's a lot of money to be made here. While it's just an obvious opportunity. When it's just so damn underserved, and I think that those networking problems can very easily be solved. That is a very simple problem to solve if you've built a network of people around the orbit of these companies, and you give them some time. So it all sounds very cool. Well, Alice, thank you so much. Let me know how we can help you in any way, and look forward to being part of this myself and our firm.
Thanks so much, Andrew. I've enjoyed talking to you. Thank you.
Okay, me too. Bye for now.
Talk now. Bye.